Hi, I'm Daniel Schwartzman, Director of the Seeking Alpha Marketplace. We're continuing our coronavirus roundtable video interview series. Today I'm joined by Bram de Haas, who is the author of Special Situation Report, a service that seeks to generate consistent, uncorrelated, and attractive risk-adjusted returns. Bram, good morning. How are you?
Good morning. How are you?
I'm doing well, doing well. So, we did a recent roundtable you took part in where you wrote something to the tune of, for a long time, it's been very simple to just bet on US megacaps and then you'll do fine. And while that's still playing out, I think that's going to change soon. And so that sounds like a bet against the megacaps. And I wanted to ask, especially because we've seen even during the crisis period, as you know, we've dropped off, we've bounced up, now we're dropping a little bit. The megacaps have still held up really well, especially the US tech companies. So why do you think that's gonna, or am I right to say you think that's gonna change, and why?
Yeah, I think so. The main reason is that they've done so well for so long, and at some there's like a large discrepancy in the valuations, while there shouldn't be such a discrepancy in the growth. There's a lot of you hear more and more pushback from like regulators and some of the big tech names. That's going to be a danger going forward. And during the crisis, I think they were treated a little bit as a kind of a flight to safety sort of trade. And I'm not sure if that's going to hold up. So either, if everything goes pretty well on the virus front and small caps should catch up, or things get pretty bad, and then I don't think the large caps are that insulated from losing revenue and having their balance sheets threatened. I mean, some of the large cap techs have really strong balance sheets, so I can see I can see why they are a sort of flight to safety trade. But I think if it gets really bad, they still they will still give up a lot of gains.
Do you, there's part of the flight to safety, like you said, do you buy at all the fact that the, not only do they have those bigger balance sheets, but small businesses, for example, are getting really hit hard with what's going on, that potentially this is reflecting more market power, more market share going to the largest companies because they're the only ones who can deal with all that's going on? I mean, Amazon is the most obvious example of somebody that's increasing hiring dramatically during this period. Does that, do you buy that at all as a potential reason, a legitimate reason, if you will, for why the large caps are doing, the mega caps are doing so well?
Yeah, I think there's definitely like a kernel of truth to the trade, or it's not completely crazy, but it just exaggerated, and I don't think it's okay. Let's say small business gets hit really hard. I'm in a sort of an incubator space with like 100 entrepreneurs. Everybody's running small, medium-sized business. And it's true, a lot of them are getting really hit hard. People run like quizzes for entertainment venues and for small companies. I mean, that's gone. There are like photographers who, do business photography. That's gone because you have to get too close. There's tons of business completely gone, but they use a lot of the products that mega caps provide, and maybe there will be a little bit of a lag before everything gets turned off. But even just company that where we all have office space, it's like 100 entrepreneurs, and I think like 70 for sure are getting hit hard. And it's very flexible lease, so that it goes through the chain, and in the end, the large caps they'll get hit as well.
Right. Okay. So another thing you said in that roundtable, more towards your investing style, is you talked about focusing on the downside, and that's something that's been the most interesting to me of this period. Is how do we think about downside? How do you model? How extreme do you get in your modeling for downside in a situation where we still don't know? We were talking beforehand about places opening back up and we don't know what's going to happen or how fast they open. What are you doing to model for downside in this period?
Yeah, I thought it was like March was a really interesting period, and things sold off really hard and fairly indiscriminately in like the smaller cap space. Um, so I just started avoiding or shorting everything that I thought was very risky, but and I didn't do like complicated modeling. I usually don't. And but I really looked like, okay, what if you have like no revenue for 4 quarters? Can you get through something like that? And there were companies out there that just have no debt or just a lot of cash, and they don't have a lot of operating expenses, and they still got halved, um, with like reliable businesses that I think would come back like in a few years or that would still do really well. So I thought that was really interesting, and I didn't have to figure out like a lot of cases that are very hard to figure out. Like, are they going to barely survive and then you're going to make a lot of money, or is there like a 30% chance that you'll get in some sort of restructuring? um, and then you'll have like a 0 or a 90% loss. So I didn't have to do that. So that was, for me, it was pretty easy because there were bargains that were just surely to survive, and that looked really attractive.
So, not to put you on the spot, but like,
Sure.
what's play out an example of a company that you have liked during this period that you're sure is going to survive and that is at a bargain price?
Yeah, like an example that's been my top position and my favorite idea for the service has been Scully Royalty. And I think it's actually, it has been written up in Seeking Alpha Pro. I think back in 2019, July or something. Um, I've had it as a pick since end of 2018. And basically, that's a company with like a market cap. At that time, it had like a market cap of 60 million. Now it's more like 90 million or 100 million. And it's got 50 or 60 million in cash, no debt. Now it has a little bit of debt. And it has a royalty on an iron ore mine that is producing like 5 million of in revenues, but that can grow to like 30 million. And it's just that company, it can go down. It's volatile. Its price is volatile, but it's not really risky. There's no debt. It's it's profitable, and there's a lot of growth there. That's that's just one example. And there's also companies that are actually sort of beneficiaries of the crisis. And yeah, I've got one that, but it's pretty morbid. But because I do special situations, I've been invested in. It's a liquidation situation, and there's this an book of annuities. So and the baseline is that you sort of benefit if the people you've insured if they pass away, because then you are no longer paying them out an income, and the reserves fall free. And slowly that was going to be liquidated. Now, this has been a very popular product in the past, but it isn't a popular product anymore because it turns out people were living very long and healthy lives. So it was not great from an investment perspective, but great for those people. So those companies were getting like liquidated, and I've picked up one of those, and I've already held it before the crisis. And insurance, like the average age of the insurance is like 85 years old, And clearly, this virus is very bad for if you're in the elderly population. But the stock goes down like 50%, and it makes no sense. I mean, I hope it, you know, it doesn't, nobody dies and it doesn't do well. And the best result ever would be if um, there's a cure for old age, and nobody in that insured group ever dies. I'd be happy. Yeah, that would be the best thing. But it is an example of like how crazy things went in March. Because yeah, I think everybody understands that that's not a company that does bad in the virus environment.
So I want to back up to Scully for a second because that's what's there. You talk about a growth play. They're earning a royalty on the production of iron ore. Iron ore would seem leveraged to the economy pretty heavily, and we're going into whatever you want to call it. We're in a recession, and it's just a question of how long. So does that not affect Scully, or how does Scully hold up in light of that?
Yeah, no, that's a great point. It is greatly affected by the economy, and I mean, China is the number one consumer of iron ore.
Right.
If China's building, iron ore goes up, and if it's not, it goes down. And then there's some things on the production side. It's really bad for iron ore prices if the economy tanks. But in that whole Scully case, that's that's such a beautiful security. I think it was a great idea on Seeking Alpha Pro too, because you could actually see like um, I bought it in December 18, and it was just kind of a forgotten security. The word got out a little bit, and like from I think early 2019, suddenly it started trading in line with iron ore. And before it didn't, because the market just did not realize that they had that royalty because that mine, it had been shut down and was going to open in mid 2019.
Mm.
It took until a press release by the company in like I think May 2019 before the market woke up to the fact, but it was already apparent. And yeah, since then it's been trading in line with iron ore. So yeah, I know I was going to get hurt a little bit from like a downturn, but I mean, it's like a 100 million market cap, and if it gets that mine ramps up at iron ore prices like they are, it's maybe 25 million in like EBITDA that you get out of just a royalty.
Right.
It's yeah,
Which a royalty
and if
means low operating costs. I mean, that's the whole idea of a royalty model is that you don't actually have to. So,
yeah, it's almost all margins, and then it runs until 2055. I mean, I know the market prices these things pretty short term, and the market is currently not very fond of like commodities and especially base metal commodities. Gold's doing a little bit better, um, but over time, I can't see how I'm going to do badly there.
okay.
And those things I really like through such a kind of difficult virus cycle. I just it's like a great option on the future until 2055, and it can't die on me. You know, it doesn't expire because there's no debt. Even if economy completely tanks and iron ore goes to $10, it will still make like a minimum payment of 3 million a year, a positive payment.
Right. The what's interesting to me is what Seth Klarman wrote in, I think in Margin of Safety about the idea of just the negative effect of worrying about relative performance. Because something like what you just said, if your analysis is right, you'd have a long time for this play out, and it's hard for it to go poorly. And obviously, you might have the analysis wrong, but it might if you buy it. If I add a stock yesterday and then it goes down, that's an immediate feedback loop telling me, oh, I'm underperforming or whatever, and that can be really that can unsettle people and um, move them off of their long term strategy. And so I think that's an interesting example of the contrast between that short term focus and that relative performance game and focusing on what you think will work for the long haul.
Yeah, I mean, I totally get that it's like hard to. I mean, like that's why momentum it kind of works, and it's very popular strategy because you put the trades on and you're immediately sort of winning. So that's very sweet. And I'm more from the like value school, and then I've added a special situation twist, and then it's the opposite. You're always losing, and then suddenly the thing materializes that you're waiting for, and finally you're winning. And until then, you're always complaining like how you're lagging everybody. Um, I think that's something you have to learn as a value investor, and you always hear them talk about like, yeah, but I know the fundamentals because I mean you constantly have to reinforce yourself. If I know the fundamentals, you just get through that pain, and I think you can solve some of it by portfolio management, and it's learning about yourself, like how much of that lag and that underperformance you can tolerate. Um, because it's hard. I mean, value's done so poorly, like deep value, and I think it's like 10, 11 years now. So yeah, I can't fault any value investors for like trying to add new tricks to their portfolios, and like something I kind of slowly gravitated towards is adding mergers and acquisitions,
Mm-hmm.
because those very often go right and on a kind of a shorter time frame. So it's a good way to you add a little bit of wins to your portfolio, and you have a kind of a bond like payoff. You make a little bit or you lose a lot. So I think that's interesting to.
Well, since you bring that up, did you a lot of merger and acquisition spreads got blown out in March, right? I
Yeah.
followed a stock that I used to own and I sold Tech Data, which, you know, Berkshire Hathaway almost made a bid for, and Apollo bought after a brief bake-off contest, and that the buyout price was 145, and they briefly touched I think 100 in March, and that was more or less where it was before all of this started. So it had basically wiped out the buyout premium. It still trades, at one high 130s. But were you active in that at all? Not that specific, but were you active in M&A spreads given the what was going on in the market, especially before the Fed really stepped in?
Yeah, sure. Yeah, I had quite a few merger spreads on, and they blew out big time. And I knew that like M&A has this profile. It's sort of like selling puts. So you're winning very often, and then they go bad. And there were like a few things that were very interesting about that time. I thought it was a bit ridiculous how some of the spreads have blown out. There is definitely for selling, like hedge funds delevering. I mean, that was going on all over the place. So yeah, clearly, also in like the M&A space, which is highly levered, and so that made it interesting. But I've got like I put together what do you call this? It's like a model for M&A, but it's like one of the variables is if you get into a credit contraction or credit crisis, like you really have to be more careful because that's when they fail much more often. So that my algorithm adjusts a little bit for. So I switched that on because I thought we were going into such a situation, and I already switched it on like in January or February, and that made a little bit of a difference. And I got very careful about which ones I've kept, but there's still like the allergen one. I had Allergan on, for example, and Tiffany's, and they all blew out. So that was painful for sure. And like the Allergan one, it finally closed like a few days ago.
Mhm.
So I didn't have one blow up. So that was great. And maybe because of the fat.
Yeah, I mean, I just know I have found that merger and acquisition is not a good fit for me, at least for various reasons. But you watch something like that, and you know the underlying company, but you also know that in the case I was talking about, it's private equity. They're going to have to go to the market to raise capital. They're still moving forward as far as retiring the target's debt or tendering the target's debt and all that. But it's just there's a special either you have to have a really statistical approach or you have to have a special expertise to be able to you know fight your way through whatever's happening because there are so many experts who are doing the same thing, so many funds or whatever.
Yeah, but I think um, there are not that many funds anymore. Because it waxes and wanes how popular these areas are. Uh, and I think that one deteriorated a little bit. A lot of hedge funds that have gone down in popularity. Private equity is much more popular lately. I like the things you mentioned there. That's um, that's completely true. That's why at one point I made sort of an algorithm, and it incorporates like 30 things that they're like academic research that all affect a little bit like your probability of closing and um, whether it will blow up and all those things. And um, that helps me to weigh like the probability will this get through, but it still changes. Like if there's a crisis like this, I mean my algorithm isn't going to be accurate at all.
Right.
Um, but I think we could see that coming.
Right.
I've, like it was a little bit. I felt a little bit bad for my subscribers because from the end of January, I've been writing about COVID-19 a lot, and I my first post it was like, yeah, there's this virus in China. It's probably nothing to worry about, but something like that. And then it sort of accelerated from there, like, okay, maybe it's a little bit more serious. And finally, because I've always been a fan of Nassim Taleb,
Mm-hmm.
and he can be like a very obnoxious person to read, but there's like a lot of gold in his books. Like I really recommend him to everybody. And he's like a great model to think about these exponential threats for how to think about those. Um, and I followed his model, and then you just have to take off risk. And I was like, I'll miss a little bit of return, which was really frustrating in February, but was nice in March.
Yeah. Taleb also, I don't think his Twitter presence helps his reputation either in terms of how easy he is to get along with. But yeah, obviously he's sort of
Yeah,
a
yeah, it
weak.
was totally deliberate on his part. Like he has this philosophy of um, he'll just agitate anyone, and especially like known people, and that just it gives him fans and enemies, but it's just the fans that are buying his books. Uh, I think he's very strategic about just going up to the biggest guy in the room and throwing punches. Uh,
That's modern marketing and positioning right there. That's a story.
yeah, yeah, yeah. I mean, it's not my style at all, and I struggle a little bit with his writing sometimes. I know maybe uh, I know you're into writing, so maybe um, you have some thoughts on it, but I struggle with it. But the ideas they are powerful and it's easy to understand. Like it's accessible.
I have to confess, I haven't read his work yet. Maybe that's something
Oh,
I need to take in my downtime. And
oh yeah, yeah. I mean, you'll be annoyed, and at the same time, it's totally worth it. Yeah, and but like things like Mandelbrot are just also super valuable, but that's much harder.
Right. Okay. So, sort of maybe to conclude, you had written an article recently called "The Game We Are In." You wrote it about 2.5 weeks ago. I thought it was a really interesting article for just this uncertainty. Obviously, Taleb is known for the black swan theory, which comes from Mandelbrot, I believe. But the idea of there's a lot of uncertainty. It's unclear where we're going in this market. And so my question to you, first of all, I know this is the first part is a little bit silly because it's only been 2.5 weeks, but I'm curious if you feel any more certainty or any more idea of what's going on. But then maybe more relevant for viewers is what changes have you been making in terms of your positioning? Like what, given this environment, you mentioned you took some risk off the table in February. Where are you now in May? What are you? How are you thinking about the market? How are you adjusting to this situation?
Yeah, I've been like slowly adding like short positions and yeah, further de-risking. Um, I don't like this rally that we're in. I've also written an article why I fear this rally, and I think I've just written one about positioning, how to position into the reopening, and it's I have to confess it's still very like challenging to me. Like, is this because there's on one hand there's like this the stimulus is impressive.
Mm.
Um, I'm more certain that like Europe will struggle than the United States, but it's also reflected in the markets. There are a lot of companies that I think are just I'm not going to invest there, and I'll try to short some of them. And those are like larger caps, usually the Nasdaq. Um, that I think that people are feeling too good. I think if you look at like the Robinhood most traded stocks, it's interesting. There's like a lot of airlines, Carnival cruises, which I'm short a little bit on some bonds. So that's uh, there are a lot of those like cyclicals, auto stocks are in there, and yeah, I can't hold those.
Mm.
So, that's what I know. Like I'm not sure because I've also followed like the healthcare developments as best as I can because I mean I just like everybody I'm overwhelmed uh, by this environment. My kids can't go to daycare. My cleaning lady she can't come anymore. You suddenly have to learn about a virus. Companies are moving all over the place, so you have to do research there. So I'm struggling with that, but um, I followed it because I believe the remdesivir from Gilead looked really interesting to me. So I've written a lot of articles about that one. That all publicly available on the Seeking Alpha website.
Mm-hmm.
And then I also had to look a little bit on like at the competition and how bad is the virus. And I'm getting a little bit hopeful that with a lot of social distancing, doctors are learning a lot more about this virus. They're treating it better. And if like we behave very well, maybe there can be some sort of reopening where a lot of businesses can work. I'm not a believer in like airlines or um, cinemas. I can't, I'm shorting cinemas because I can't see how that will work for a long time. And yeah, so I'm a little bit hopeful on that, like that we can mitigate it by behavior and with therapies. And then on the vaccine side, I'm a little bit cautious. Like we'll see. We'll see when that gets there. Even if it gets invented, it's still we'll all have to get it, and the country that will invent it, maybe, you know, they'll be covered. But what about other countries? It's unfortunately a global crisis.
Right. We were talking before, and to me, it seems like I'm still generally long term optimistic that all those ingenuity that you talked about in terms of treatments, in terms of eventually the vaccine, etc., producing the vaccine, will get there. The interim period, the market seems quite optimistic until this week it's finally started selling off again a little, but it's been quite optimistic when even what you described as a bullish case where we behave ourselves essentially and reopen, that's still going to be a subdued environment, and it's a big if we behave ourselves. I think counting on everybody to observe the the best practices there is more optimistic than I am.
Yeah, yeah, and I'm not sure what it will do. Like maybe we need, to have those images of people in the ICUs and that those are getting filled up again to feel scared enough to behave. Um, and maybe when we get those, the market gets scared again. The market is pretty good at looking through these challenges, but really, I want balance sheets that are really safe. Just I don't want to be like feel dependent on the government saving me.
Mm-hmm.
But I also really hate that feeling that I really start to root for like a bailout or something because I need it in my portfolio. That's not something I like. Uh,
Well, it's just I think that's maybe what we talked about downside. Maybe that's how the way companies that have their fate in their own hands that becomes more attractive because they can. You just have more confidence that they. It's both de- creates a path dependency of they'll survive, but also it probably means they're a better company if they have control of their future.
Sure. Yeah. And maybe one thing I'd like to add because you threw like better company in there, and I think in the big sell-offs you can get like great companies for cheap. But something that's been going around in my mind is that I'm not sure if I think we're going into a deflationary like contraction and then maybe later inflationary. But inflationary stuff is really cheap because people hate commodities, like commodities and like these bad businesses that sort of um, are, you know, those can do really well in inflationary environments, but we haven't seen an inflationary environment for a long time, and we haven't seen like a huge growth boom that required a lot of resources in a long time. So those are down and out, and they're really cheap. So it's sort of cheap inflation insurance.
Mm-hmm.
And if it doesn't happen, it's still a company that produces something for you. It's a positive carry inflation insurance.
So maybe let's stop. What's what example? What's an example of that? You mentioned Scully earlier, but is there another
Yeah.
example of that, or is Scully your best example of that story?
No, there's like I think there are two good examples, and one is Altius Minerals from Canada, which is like a base metal royalty company,
Okay.
and it's just trading at a low multiple. I mean, for a commodity miner, it would be a high multiple. For royalty, it's not a high multiple. And then there's a lesser known name that's Anglo Pacific from the UK,
Mm-hmm.
and there's just great management, sound balance sheet, a lot of diversified commodities. They started out in like one of the worst when current management got there. They were like all coal, um, and now they're slowly moving in, the battery metals direction, and so that's their future. And it's a diversified portfolio, and it's really cheap. Um, I can see it die in however bad the crisis gets. And at some point, people start building, using resources. Even if we, totally electrify and all those things, you need copper. Yeah. So I like those. They're cheap and they work in inflationary environments.
Okay. Very good. Good stuff. So I've been speaking with Bram de Haas, who is the author of Special Situation Report on the Seeking Alpha Marketplace. You can look it up on the marketplace. Bram is Bram. You just type that in. His name and his service should pop up in our search bar. Bram, before we finish, any disclosures in any of these stocks named?
Ooh, yeah, I think I'm like long everything that I talked about in a positive way, like Altius and Anglo Pacific, and mm, what else did I mention? Like
Golly,
Scully, I'm a long Scully, it's my
uh,
biggest position. I
Gilead
still
or
have the Tiffany's
okay, right.
on.
The Gilead, do you have a Gilead position?
Yeah, Gilead. Yeah.
Great.
Um,
And you said you were short the Carnival bonds specifically.
yeah, I actually own the bonds and I'm short
Oh.
through a put.
Short the equity through a put, own the bonds to
Yeah.
very interesting. Okay, great. We briefly mentioned Berkshire, which I am long
Oh,
myself.
I'm long Berkshire, sorry.
Okay, we're both
The-
the B shares. I don't know. Uh,
Yeah, I sold a put, yeah, because I thought they would buy back more. Like, yeah, didn't happen.
yeah, it'll be Berkshire. I think that's a still a pretty. I'm pretty comfortable holding Berkshire, even if Warren is more cautious in his current period.
Yeah, sure. I think that's a fantastic stock. He's getting way too much flack. I mean, he's best investor of all time in my mind. So,
Okay, great. So again, speaking with Bram de Haas. Bram, thank you so much for joining me this morning.
no, thank you for having me. It was great. Thank you.
Yeah, absolutely.